It does seem like negative interest rates, or the prospect for negative interest rates, is all over the news cycle the last week or two. And it's true that our rates here have dropped by about 50 basis points since the last time we did a video a month ago, which is pretty extreme. And I think that kind of one-way rapid move is the reason for the discussion about the prospect for negative interest rates. It certainly could happen. The overseas markets are showing you that it can happen. I don't think it's as imminent as the recent headlines would have you believe. We were over 2% a month ago, and now we're closer to 1.5 than we are to 2. But for them to go negative would be an enormous move from here. I don't know that I've really read any intelligent commentary on what negative interest rates actually mean. Nobody was really prepared for that to happen anywhere, whether it's here or in Europe or in Asia. Obviously, what it means is you're being paid to lend someone, to borrow money. So if you wanted to lend me money, I would actually charge you for that, which is kind of insane. Well, not only are you not getting any interest on it, you're paying for the right to park your cash somewhere. And I guess, I've seen some interesting thoughts on Twitter where people are suggesting that maybe that's actually the natural state of things. You have to pay for someone to hold on to your stuff, whether it's gold like in the old days or whether it's your cash today. I've always believed that gold was a hedge against a falling dollar because it's priced in US dollars. Gold is measured by the ounce, and it's priced right now, it's about 1,500 US dollars per ounce. So, but the dollar hasn't been weak at all. There are reasons that it might start weakening, but it's pretty close to its highs for the last few years. But I think maybe there's a new narrative that's building that gold could be a hedge against just uncertainty in the currency markets generally. Not necessarily a weaker dollar, but just uncertainty in foreign exchange, which kind of makes sense because with negative interest rates in half the world, what does that say about the currencies of those countries? I think that's kind of, it definitely represents a hedge, but I haven't seen people really make a compelling case for why it's a hedge against inflation as opposed to deflation or as opposed to a weakening or strengthening dollar. It's just people have been running to gold. That's the reality. Taking it back to August of 2015, if you remember, there was a shock devaluation of the yuan, and it came on a Sunday night, and U.S. markets responded very negatively. It caused a huge correction, which we did ultimately recover from. And I think people are starting to get nervous that we're approaching a similar moment where they might have to do a large devaluation all at once. What I think is happening is they're just simply responding to the tariffs. Their goods cost more for people to buy if they're shipping to the United States. So in order to account for that, they are allowing their currency to depreciate. They're not actively manipulating it lower. What the Central Bank of China is actually doing is they're stepping in and they're strengthening it overnight. They're just not strengthening it as much as they have been. So they're allowing their currency to fall closer to what it would fall to naturally if they were not propping it up at all. I think the further escalation goes, the closer we're getting to a deal. You read people saying, "Oh, we're further apart, we're further from a deal now." That doesn't really make sense to me because if there were no hostility and no disagreements at all, then there's really nothing to talk about. So I think both sides have put themselves and the other in a position where they're feeling some pain. We're feeling pain here, like you said, with the farmers and basically any industry that is doing any kind of business with China whatsoever, either buying or selling. So, and China's, of course, feeling the pain too. we are in fact buying less from them than we were.
Right.
So the more pain that both sides feel, I think the closer we're getting to some sort of a deal. And neither side is probably going to get exactly what they're looking for. China can't realistically allow their currency to just depreciate against the dollar and against other world currencies. Reason being, one, the weaker their currency gets, yes, their goods become cheaper to export in relative terms, but they've got 1.5 billion people who are consuming. And they don't have a huge middle class, but it's growing and their wealth is growing, and they buy stuff that's not made in China. So their purchasing power will go down. Also, their upper class, the Chinese people who do have a lot of wealth, they're looking for protection against a depreciating yuan. Because if I've got $1 billion worth of Chinese currency, but I don't trust my government's ability to keep the currency stable, I'm going to be working really hard to get that out. And I can do that by buying gold, by buying foreign assets, by buying U.S. stocks or real estate, treasury bonds. So they don't want that. They don't want a mass exodus of capital. So that's one reason why they may actually kind of have to step in and strengthen their currency, or at least not allow it to weaken in perpetuity.